This episode of the Renewable Energy Smart Pod is brought to you in part by KPMG. There's a race for renewables to power 77% of the world by the year 2050. Today, renewables only generate 14% of global energy. Have you ever wondered what's holding us back? A new report from KPMG titled Turning the Tide in Scaling Renewables tackles that question and more. To read the report, visit kpmg.com/US. That's kpmg.com/US, or just click on the link in today's show notes. Today's episode is also produced with support from Vinson Elkins, a leading law firm with deep experience advising clients on renewable energy projects. To learn more about Vinson Elkins, visit velaw.com, or just check out the resources in today's show notes. What's up, everyone, and welcome to the Renewable Energy Smart Pod. I'm your host, Sean McMahon, and today we're going to spend some time talking about the role the U.S. government is playing to support the technologies and companies that aim to power our energy future. The passage of the Inflation Reduction Act and the bipartisan infrastructure law have armed the government with hundreds of billions of dollars that's being directed at projects in the clean energy and advanced transportation sectors. And if you work in the renewables sector, you probably already know that Energy Secretary Jennifer Granholm has been a familiar face in the news as she's been barnstorming the country to promote the investments the government is making in high-impact energy and manufacturing projects that are delivering jobs across America. And some of those projects are where today's guest comes in. You see, many of the loans and loan guarantees that make those projects possible have been facilitated by the Department of Energy's Loan Programs Office, aka the LPO. To learn more about exactly how that office does what it does, I'm going to be joined in a minute by Chris Creed, the Chief Investment Officer at the LPO. Chris, Director Jigar Shah, and the rest of the team at the LPO are working hard to help the Biden administration deploy public funds and attract private capital to help established companies expand their operations and newer companies build what the LPO calls a bridge to bankability. It's a fascinating approach to advancing the energy industry, and Chris is certainly passionate about the work that the LPO does, so I'm sure you'll appreciate hearing more details from him. Real quick, this is the third of 3 episodes we've done recently that focus on financing the energy transition. I've also chatted recently with Alfred Johnson, the co-founder and CEO of Crux, to hear more about the market for transferable tax credits. And most recently, I was joined by Luis Silva from EDF Renewables to get his perspective as the CFO at a major developer on the current financial landscape for renewables. I hope you get the chance to enjoy all 3 of these episodes that are all about money and renewables. But right now, let's get things going with Chris Creed, the Chief Investment Officer for the Loan Programs Office at the U.S. Department of Energy. Chris, how are you doing today?
I'm doing very well, Sean. Thank you very much for having me on the program.
Yeah, it's a pleasure to have you on here. Listeners of the show are probably pretty familiar with what the LPO does, but let's just spend a quick minute. Why don't you walk us through the details of the work you do and the overall mission of the office?
Yeah, absolutely. I mean, our mission is pretty simple. We want to be the premier public financing partner to help accelerate high-impact energy and manufacturing investments to advance America's economic future. It is a tremendous mandate that Congress has given us. And in order to do that, we administer various loan programs authorized by Congress to help American entrepreneurs and American businesses grow in the energy space.
That sounds good. Simple enough. A simple enough mission, maybe not as easy to achieve, but y'all are working hard. What are some of the highlight or, kind of big name projects the LPO has financed recently?
Yeah, I mean, there's been a lot of transactions that have been in the news. Maybe one grouping of projects that I want to start with is the investments that we have made in the electric vehicle, EV battery, and EV battery supply chain markets. So when you think about this growing and important contribution to the clean energy future that we think is coming. We have been helping companies finance projects across the spectrum. So we lent money to Syra Vidalia, the first active anode material assembler in the United States, taking graphite from Mozambique and making anodes in Louisiana. So that's your anode. There are many cathode projects that we have been involved with. We have conditional commitments to Lithium Americas. We have been working on battery recycling facilities in Redwood Materials and Li-Cycle. There are a number of projects that are behind the public wall that we're working on right now. And you need somebody to put those together. So we've been working with GM and their technology partner, LG. We've been working with Ford and their technology partner, SK. And that helps build the packs that'll eventually go into the automakers' cars and help bring about the EV sales that we are all predicting will continue to increase over the next decade.
Yeah, we've heard a lot about kind of revitalizing manufacturing and, the battery belt, if you will. So it sounds like you and your team got your fingerprints all over that.
It's interesting because, the number of projects is quite large, and some of them are interrelated, right? If you have a sort of downstream project, it is possible that an upstream project might be a customer of the project that we're funding. And so the ultimate goal, though, is a EV market that allows for us to be a global or the global leader in that industry.
Well, it definitely sounds like exciting times in the EV sector, both, the battery and the whole supply chain. What about some of the other stuff? Listeners to this podcast are big into wind, solar, other forms of battery storage. What do you see the most activity, or I don't know if you can disclose the most applications or most kind of interest? What's the LPO seeing on that?
Absolutely. Every month, actually, we do disclose to the public our monthly application activity report. So if you go to our website, we, in a high-level way, give information about what our applications look like. And we break them up into a technology taxonomy and show the public where our applications are. And they range from renewables, nuclear, offshore wind, EV and battery supply chain, virtual power plants, manufacturing. They run the gamut. Some other projects that I think your listeners are probably familiar with, we did a loan guarantee for Sonova. That was our first distributed energy project. It was distributed generation with virtual power plant technology. And it helped for both distributed generation and distributed storage of power in residential homes across the United States, with a particular focus on low and moderate income Americans and a particular focus in Puerto Rico. And so that project helped American homeowners gain access to financing that would allow them to lower their energy bills and participate in distributed generation themselves. Looking at a couple of the other projects that your listeners might appreciate, one of our first projects that we did was ACES Delta. This was a project that took excess renewable generation in California, used transmission to bring that power to Utah. That power was then used to power electrolyzers, which made hydrogen. The hydrogen was then stored in salt caverns and then pumped back out for use in combined cycle gas turbines to generate electricity again, sent back to California over those same transmission lines, and used by LADWP for power, effectively seasonally load shifting renewable energy. And a cool project where there were private sector partners, public sector partners, and us as the financing partner. We also were very proud to announce the first tribal loan deal in the history of the office a few months back. This was a microgrid project for a tribe out in California to help build solar and battery storage for a location just outside of San Diego. We have been very active in some of the other hydrogen projects. The very first conditional commitment that this administration put out was for Monolith Materials, and they make carbon black and hydrogen through a pyrolysis mechanism taking CH4 and then decomposing it. So really cool projects that help bring about in a lot of different technology sectors, companies that will help be leaders in these technologies globally.
Yeah, I appreciate you kind of painting the picture across the whole spectrum of projects. You've talked about how you kind of spread across the technology, solar, battery, hydrogen. But as someone who's kind of in charge of all the investments, I come from a finance background. Portfolio managers kind of want to be well diversified in many ways. So what's the LPO's ideal cross section of their portfolio in terms of the maturity of companies? I mean, we hear a lot about startups getting funding. There's also some well-established companies that are expanding. What's your goal there?
So I think it's important to talk about one of the objectives of the Loan Programs Office. It is to be the debt financer to help catalyze through debt these important projects. But we are emphatically private sector led and government enabled. And so whilst we are cognizant of portfolio impacts, we look at, from a portfolio perspective, concentration limits, whether they be counterparty concentrations or technology concentrations or program concentrations. We don't select companies based on that. We are active through our outreach and business development team, talking to companies, stakeholders, whether they be community stakeholders, labor stakeholders, environmental stakeholders, the broad array of stakeholders, making sure that everyone understands our program. And then those companies, those entrepreneurs and businesses that want to take advantage of our program to help gain debt leverage, to cross that bridge to bankability, that metaphor that we use, the idea that we are there to help companies that have not just a really good idea that they have demonstrated, get across that bridge of bankability to full capital markets acceptance. People often ask us sort of, what risks do you take? And we don't really take will it work risk. For your listeners, I'm using air quotes. It works. It works in the lab. It works at the demonstration facility. What we're there to do is help scale that up. We're there to help take cost curve reduction risks, scale up risks in terms of, can I build 10x what I was building? At the risk of giving away too much of the secret sauce of finance isn't that hard. We have, if we're building a widget factory, I have the cost to build the widget factory, and I have risks that my costs are higher than I estimated. I have O&M costs to run the widget factory and risks around that. I have risks around what am I selling my widgets for, and will my counterparties pay me for those widgets, and risks around that. And I have feedstock and raw material price risk. And what we're here to do is provide debt to these projects, make sure we've decomposed all those risks and looked at them, and then help those companies, especially in Title 17 in the 1703 program, those that either can't get private financing or who have trouble getting private financing at the scale that would be required to be successful, give that financing to allow them to be the next great entrepreneur. And that's the really cool part about this job. If you look back at the history of the LPO, whether it be Tesla or utility scale solar generation or wind, there have been a number of very strong success stories coming out of this office. It's our hope that with the mandate and the imprimatur that Congress gave us through both the bipartisan infrastructure legislation and the IRA, we can duplicate that success across many more industries.
We'll be right back. Just a quick reminder, everyone. I want to again thank Vinson and Elkins for their support with today's episode. Please be sure to visit velaw.com, or you can check out the resources in today's show notes to see how Vinson and Elkins helps guide clients through every step of their renewable energy projects, from development and finance to regulation, tax, patents, and more. This episode is also sponsored in part by KPMG. There's a race for renewables to power 77% of the world by the year 2050. Today, renewables only generate 14% of global energy. Have you ever wondered what's holding us back? A new report from KPMG titled Turning the Tide in Scaling Renewables tackles that question and more. To read the report, visit kpmg.com/US. That's kpmg.com/US, or just click on the link in today's show notes. And now back to my conversation with Chris Creed, the Chief Investment Officer at the U.S. Department of Energy's Loan Programs Office. So you mentioned the 1703. What is that for our listeners?
Yeah, absolutely. So we administer, as I mentioned earlier, a number of different loan programs. The largest of our loan programs is the Title 17 Clean Energy Finance Program. And it has two components right now. The 1703 program for innovative clean energy and the 1706 program for energy infrastructure reinvestment. The 1703 program is the one that has the innovation requirement. It has to be projects that have novel or second of a kind style risks. And this is really where the bridge to bankability metaphor really fits. We're trying to help these projects and companies that have a really interesting idea, again, that has been tested, works in a lab, has a demonstration facility. Generally speaking, we know that it works. We're helping them get to commercial scale. The 1706 program, the Energy Infrastructure Reinvestment Act, is the large-scale program. Congress in the IRA gave us $250 billion of loan authority and $5 billion of credit subsidy. If your listeners wanted to think of that as loss reserve, that wouldn't be too far off the mark. To lend to rehabilitate, replace, uprate existing energy infrastructure. And in particular, utilities are mentioned in the legislation by name, but utilities are likely to be one of the big users of the 1706 program as they look to take their aged energy infrastructure and greenify it, reduce greenhouse gases through these infrastructure investments. Away from Title 17, we have the ATVM, the Advanced Transportation Vehicle Manufacturing Program. And that's where a lot of our EV, battery, and battery supply chain transactions fall under. So the large conditional commitment that we made to Ford, the loan that we closed with General Motors, the transactions that I mentioned earlier with Syra and others, those all fall under the ATVM program. We also administer the tribal program. And like I said, we're very proud that we had our first tribal transaction reach conditional commitment earlier this summer. And depending on when this podcast airs, maybe we'll have closed. And then finally, last but certainly not least, we have a carbon dioxide transportation infrastructure program, CIFIA. And while we have not made any conditional commitments on that program yet, it's another program that was formed under the BIL and one of the loan programs that we administer here.
One of the things I see a lot on the LPO site is a phrase called the bridge to bankability. I love that phrase for starters, but tell us more about that.
It's I think, really good metaphor to help explain, especially in our 1703 program, what we're trying to do. We have applicants, companies that come to us that have a really interesting product. They've developed it, they've demonstrated it, but they need to get it to commercial scale. They haven't yet gotten the size or de-risked enough of the other components of the project to get private capital financing. And so we're there to help them cross that metaphorical valley. And so we help provide financing to first, second of a kind projects that when they cross that bridge, not only are they able to then turn around to the broad private capital markets and say, hey, we just built our widget factory. It was super successful. Here are our numbers. We want to build a second factory. And the private capital says yes. But potentially other companies will say, oh, this is really interesting. And they are able to get private capital as well because we've shown the path. And broad private capital acceptance is sort of the end part of that bridge. And so when we look at that metaphor, it sort of helps people understand what are we here for, especially in understanding how we are complementary to private financing and not supplementary and crowding out private financing.
There's also something, when you dig into the LPO and kind of what you guys do, there's another phrase, patient capital. Explain that to our listeners.
We want to be there as a lender. I think today's EV zeitgeist is probably a good example. We sold more EVs in 23 than we sold in 22. We're going to sell more EVs in 24 than we sold in 23. To butcher a Mark Twain quote, the death of EVs is greatly exaggerated. But there are certainly investors who had growth forecasts that were higher than we are realizing, and capital is constrained. And we're continuing to underwrite our transactions. We're continuing to see new applicants, conditionally commit to our older applicants, and close on deals that we've completed due diligence on. And we're going to continue doing that. It's important. It's important for the country. It's important for our economy. And the communities that these projects and companies are located in, they depend on it. Once we close on a deal, we also are strong partners with our portfolio companies to help them get through tough times. Our realized default rate is a little bit under 7%, and our realized loss rate is just a little bit above 3%, which is substantially below our at time of origination estimates. That is, I think, in part because of our strong technical underwriting, our strong financial underwriting, and our strong active portfolio management of projects post-close. And working with applicants, working with our borrowers after they've graduated from applicant to borrower, understanding their business and working with them, that is, I think, part of the key to the success that this office has had.
Okay, I want to get back to how the LPO works with applicants in just a second. But one of the misconceptions I think is out there is that LPO kind of provides all the funding. When they hear about these loans, that it's just coming from DOE and LPO. And people don't always understand that you're bringing in institutional investors and equity partners and things like that. So how does LPO work to de-risk investments from those kinds of entities?
We are strictly debt lenders. We provide the debt. I know your audience is sophisticated, but for other audiences, I usually make the metaphor, we're the bank that provides the mortgage on the home. Somebody's got to provide the down payment. That down payment is mostly sponsor equity. Many of these sponsors need to go out and raise equity capital in the marketplace. And so statutorily, we can't lend more than 80% of the project's cost. So 20% needs to come from somebody else. In reality, we don't usually get to that level of leverage. Think 55 to 70% on average. And obviously, it depends on the risk of the project and the individual project specifics, but that's a good range for people to have in your head. Now, I think that the LPO de-risks projects in a number of ways. The obvious way is we provide relatively long-term, relatively attractive debt financing. And so just from a math perspective, that increases the equity return through high-quality leverage. However, I don't think that's the only place where the LPO helps de-risk. I think that we did our underwriting, that we went through the 2-year process, parenthesis, we're trying to get that down a little bit, to underwrite the loan, understand the business, understand the technology, understand the risk, and then stress test that in a way that gets us comfortable. I also like to think that helps send a signal to the equity markets, the private equity markets usually, that, hey, this project went through the LPO process and came out with a loan offer.
Okay. And now I want to get back to, you mentioned kind of when applicants graduate to be borrowers and that. I just want to touch on what the interaction with the LPO is like for applicants. So if I'm a company coming in, what am I facing? I know that you and Director Shaw have done a great job of, trying to attract companies like, hey, come to us. We're here to help you. But, when they walk in the door, what does that interaction look like? And what can they have prepared to speed that process? You said it's 2 years. You're trying to shrink that timeline. What should they bring to the table and be ready for?
Yeah, I mean, I will give Jigger a ton of credit. Obviously, Secretary Granholm's leadership has been instrumental. We have very much changed the office over the past 3 years. We have added a new division within the LPO, our Outreach and Business Development Division. We have staffed that up with industry professionals from a variety of different technologies. And they have gone out to explain the program to different key stakeholders, different industries, different groups, to make sure that they understand how our process works, because we're the government and it is different than the private sector is used to seeing. And it is our OBD team's role to help translate that. They will be with our applicant throughout the life of the loan. They bring our applicant in, and their primary objective, their sort of goal, is to help our applicants form a high quality application. And what that means is going to be different for different types of applications. But the overall objective is that you are able to proceed through our office in as optimal a way as you can. And that, I think, has been something that we have spent an awful lot of time on over the past 2 or 3 years. And we're now starting to see some of the dividends from that investment now.
All righty. Well, dividends and investment kind of leads me to my final question here. And you touched on a little bit earlier about the performance, how you guys are doing in terms of, default rates and loans and things like that. So give me the whole picture. You're working hard. What's the performance look like?
Very interestingly, our utility function, our objective, right? Our mission is not returns to LPs. So our mission is catalyzing these amazing energy projects. And so our really relatively low loss rate of just very low threes right now, relative to our at time of origination expected ratings of double B minus ish, maybe single B plus, double B minus ish, is really, I think, very strong. And over that time period, we've reduced, sequestered, or avoided a significant amount of greenhouse gases. We've allowed for a significant number of Americans to be able to find high quality jobs in the part of the economy that we all think is going to be a primary engine of growth, of GDP growth over the next decade, 2 or 3. Every year we publish our annual report, which goes through those metrics. But our objective over the year is to see how many of these loans can we close, and how many of those closed loans can draw and complete their projects and accomplish their own business goals and become the next great American company in their industry, which is, really cool to see.
Yeah, I agree. It sounds like, you and your team, your performance is measured on more than dollars and cents. Really, it's just success of these companies.
I wish I could tell you we had a 9.3 net return to our investors, but that's just not, we're not trying to make money. We're not. We're not trying to make money for the federal government. We're trying to be good stewards of taxpayer dollars. We're trying to underwrite high quality loans, but the mission is to be a financing partner for American entrepreneurs and businesses to create amazing high quality jobs in all 50 states in an industry that is growing and is important and will help be one of the major tools we're using to combat the crisis of our lifetime. It's a amazing seat to be in. I have a tremendous amount of thanks for Jigger and for Secretary Granholm for giving us this opportunity, for Congress. And if it sounds Frank Capra-esque, it is because it is. It is awesome.
Well, I can't say anything other than I just wish you continued success to you and the team at the Loan Programs Office and the wider DOE. Keep doing what you're doing.
I really appreciate it, Sean. Thank you very much for having me on. I look forward to hearing other exciting guests on your program in the future.
Well, that's our show for today. But before we get out of here, I want to say one final thank you to the folks at KPMG and Vinson Elkins for their support in producing this episode. If you like this show, please subscribe or follow us on Apple, Spotify, YouTube, or wherever you get your podcasts. And as always, please be sure to share it with your friends and colleagues. The Renewable Energy Smart Pod is brought to you by SmartBrief, a future company.